Welcome to another episode of DC Close-Up, where we focus on the DC issues that matter now and those that shape the long term. I'm Lesley-Ann Morgan, Global Head of DC in L&G's Asset Management business. You may have seen our recent DC private markets campaign, Wish You Were Here, where we explore how we've packed in a lot since launching our own private markets offering. And in timely fashion today, we're going to get closer to private assets and how they've become part of the DC journey, not just for us, but for the wider industry. And who better than to discuss this topic with me than Martin Dietz, Head of Diversified Strategies at L&G and the fund manager behind our own private market strategies. Welcome, Martin.
Hello.
I'm also delighted to welcome Robert Waugh, Independent Chair of the L&G Mastertrust Trustee Board and part of the Investment Committee. With a successful career in investments and pensions, I'm looking forward to hearing your insight on this topic, Robert. Welcome.
Thank you.
With all the momentum around private assets in DC, it's hard to imagine that we didn't have private assets in DC just a few years ago. But there has been a lot of regulatory and policy development in that time. Robert, if you think about it from a trustee perspective, how do the trustees get comfortable with private assets?
Yeah, I think from a trustee perspective, the big shift wasn't the change in policy in terms of Mansion House Accord and the like. It was actually the change in regulation that enabled us to invest in them. So predominantly the production of LTAFs, which the government had driven, which gave us the opportunity then to pursue a DC strategy. So before the likes of LTAFs, you could believe in the long-term value of illiquids and that you were going to get some kind of premium and extra diversification. But the operational risk, the liquidity, the valuation, the fairness between member cohorts, it was just too hard to manage.
You couldn't really do it.
You couldn't really do it in a daily DC environment. So the rules were forcing us to have daily pricing, daily liquidity, and that made it remarkably difficult until the LTAFs were produced. So the introduction of the authorised structures gave us something tangible to assess and posed a lot of questions to us because liquidity is a major issue. Because our members need to be able to transfer their money in, transfer their money out, take their pension when they want to take it. You've then got issues around valuations when it comes to private markets. You've got issues around fees, particularly performance fees, and you need governance to meet all of those. So the Mansion House initiative helped frame the direction of travel in the industry, but they don't override trustees' fiduciary duty, in our opinion. So for trustees like us, the job remains the same, to look after members' interests. Just because the government's encouraging something doesn't mean it's appropriate for our members, and we will only continue to do things where they are in our members' best interests. So in practice, policy raised the ambition, but it's the structures that got us there. And then there was an awful lot of due diligence, as I'm sure Martin would agree, going through actually just what Martin was going to invest in, how we were going to invest, what the structures were, what the fees were, what the liquidity at different levels of the fund were. And, there are different areas of the industry have gone further and less far on this. We think you've got to be careful about how much you put into private markets. We've seen failures in the past. So a lot of due diligence to make sure we got comfortable with it all.
Great. Thanks very much. Martin, can we just touch on some of that? If I take you back to 2024, when you were kind of setting up what we were going to do in the Master Trust with respect to private assets, there were lots of different structures being discussed at the time, and you went down a different route to our competitors. Can you take us through kind of why you did that, what you actually did, and why we think that might be beneficial for members?
Yeah, I think the real starting point for us was to think really hard of what DC needs and to make sure this is a structure that works in a DC environment and not the more generic private market structure.
Good point.
So private markets have been used in the pension world for a long time. They're very well known for DB investors, but they're just specific requirements that we thought make sense to think through and work through that are really important for the DC scheme. And so to start with them really, first of all, we know DC is daily dealing. And so we felt it's really important to support that and to have prices that feed through from the private market assets on a daily basis, so that any news that we might have feeds through to the member price all the way. We discussed a lot about treating members fairly. And I think this is really an area where, yes, most members will be invested for a long time period, but still, we have daily contributions, we have individual members changing their mind, we have people at some members only being invested for shorter time periods. So we cannot just rely on the long-term kind of performance. We need to make it work over shorter time periods as well. And that was also very, very important to us. We thought about deployment a lot. We felt that, again, it needs to work for members at any point in time.
Yeah.
We do not potentially have the time to say there will be a private market offering available in a couple of years' time.
Yeah.
It needs to work very early on, and it needs to work in many ways over the short term. So, for example, lots of the standard private market structures, the more closed-ended funds, they take a very long time to deploy. So you make some commitments now, and they get used over the next couple of years. Members do not get exposure to private markets until all of this actually happens. So the deployment is a problem with these structures. But second of all, the performance is also potentially a problem, because there's lots of costs. They might happen very much at the start of these structures.
On some of these other structures.
Yeah, on the closed-ended structures. So they might pull performance down initially. So the combination of these two is really what's known as the J-curve. We felt that we need to solve these problems. So one of the key early decisions was to say we want to start with more evergreen funds, evergreen private market funds. And the benefit of these funds is they give quicker deployment, they help us get exposure to members very quickly, but also they give a diverse range of assets very quickly. We spread the exposure across the world. We spread the exposure across different vintages. So young assets in development, but also existing assets that produce some income. And that makes it much easier to treat all of the underlying members fairly. Now, at this point in time, these evergreen funds have helped us. They helped us to deploy. They helped us to get diversification. I think we're now moving into the next phase. So we are at a very big scale now, and we can now rotate, and we can find the new kind of model to grow the portfolio further. With much scale in private markets, there's now new investment opportunities simply for us. So we are moving into closed-ended funds. We are moving into mandates and co-investments. We've done all of these different private market investments already, but it was really important to get the sequencing right.
Yeah.
So the evergreen funds, they were required at the start. And to be fair, they will not disappear. We still need them. And Robert talked about the liquidity for the member and for the underlying scheme. We still need them to allow for a bit of rebalancing over time. We need them if one of our schemes might change their mind. So they're still going to be part of the toolkit. And we really have a range of implementation options now. Now, one of the last decisions that I think are really important are we wanted assets that are working in DC in the sense of assets that the members like to see in their scheme, that we can showcase to them. And there's really so many interesting things for them to see. Renewables, kind of the renewable energy assets, some affordable housing, other positive kind of property investments, infrastructure overall. I think UK kind of growth companies, a lot of these things I think are really important for them. So yeah, I think to summarize really, these initial design choices, they were all really about delivering something to the member that works from day one, that scales. And now I think that continues to deliver. What's really important now is to get this right going forward, to find the right assets, to manage them well, and to make it a success for members and improve their outcomes.
Great. And I really love that point around we thought about the member first when we were doing this. We didn't look at other structures that worked for other types of clients. We really thought about this from the member perspective. So that's really great.
Absolutely. And I think this is where the interaction between the DC team, our own private market teams, and the investors was really, really important. This wasn't driven by one of these different areas. It was a very cooperative way of finding the right solution.
So, Robert, what about your lessons that you've learned? You've been in the industry a long time. If we look at kind of best examples of who's doing this well in the UK or overseas, what does best in class private asset investment look like in DC?
Yeah, I mean, it's a great question because we haven't seen best in class in DC in many places, but we have seen best in class in private asset investments, particularly in the DB space. And you need to be large because actually to get the diversification in this space and to get involved in the sort of projects that are available to you, you're often taking stakes in multi-billion pound companies or multi-billion pound assets. And the big lesson at the start is it's not just about making an allocation, which seems easy. It's actually about managing that allocation. When you run quoted portfolios, you can always sell something if it goes wrong.
Yeah.
When you run private markets, you quickly learn that when something goes wrong, you're on the front page of the newspaper for a real asset in a real world, or, your water companies put sewage in the wrong river, or your wind farms lost a blade, or whatever it is. So you start to move into real world experience from a sort of one step removed quoted world experience. And what the good schemes do is they invest for the long term. And this is really interesting. It's quite different from private equity. You're not investing with the idea you're going to churn this asset. You're often investing with the idea that this asset's going to meet someone's retirement.
Yeah.
So you could actually go and buy a wind farm, run it for the 25-year life, then repower it with another wind farm for another 25-year life, and hold it in your portfolio for the whole time.
That's
You
a good
could
point.
own a toll road for 50 years. These assets have remarkable cash flows that meet the cash flows of your liabilities, i.e. people's pensions. They pay out every year. And the asset itself, can go up with inflation. And the inflation linkage is incredibly important in DC. So you can't just treat them as a bolt-on. You've got to treat them as part of your whole portfolio. And that's really important when the team who allocate to Martin think about it. So when we look at something like data centers, Martin might go and invest in data centers. We often have to think about what's our quoted exposure to data centers as well.
Yeah.
Because, the heavy concentration of the US quoted market, we could end up.
Yeah. So you think about the portfolio as a whole rather than just piecemeal.
Rather than just the piecemeal private market bit, yeah. So I think, the next evolution for us is take away layers of decision making, get closer to assets, co-invest rather than fund invest where we can. And then the really interesting thing is when you get to building and developing assets rather than just buying them in the secondary marketplace. And that's where you can really get to the member-friendly bit, when you can say some of those new affordable housing down the road from you, we built those. They've benefited your community. We've helped reinvest in the transition to avoid a climate crisis. And these are assets, where you can really make a difference. So I think, in the long term, that's where you end up going. A lot of the work L&G's done in regenerating cities, fantastic stuff for DC investors to see. And then as trustees, our job is to keep that oversight, not just say, we've made the investment, we're happy, we've done our due diligence, continually kicking tires, continually checking which assets we're going into, what's happening to the cash flows. So it becomes more dynamic as we develop that process. We have a close working relationship with Martin. And as the exposure increases, the reporting has to change, as Martin knows. The conversations get deeper. We need more valuation checks typically, because as you move away from funds into direct assets, we have to be comfortable with the valuations of those assets. So it's all about, are they being run well? Are they giving us fair, transparent pricing for our members? Are we getting some inflation hedges? Are we getting some diversification? And that really can all be done.
Great. Martin, I'm going to pick up on one of the points that Robert was making there about evolution. I mean, we're relatively early in DC assets. We're investing in private assets, but already we're having conversations about what does this look like in retirement? Should private assets be included in retirement? And Robert was just talking there about some assets can be used right the way through from pre-retirement into retirement. Where do you see the evolution going here for DC?
So we started in accumulation, and there we have these private market assets to provide some diversification. We're targeting long-term growth potential. We want to get exposure to some real-world assets, infrastructure, private credit, and real estate. And they can really give different different drivers of growth for that portfolio. So we've built up the toolkit, we've increased our capabilities and our experience in running these assets in a DC-friendly way. In retirement, or at retirement, what we're currently seeing is we're seeing a lot of the members cashing out early. And thereby, I think they are requiring a lot of liquidity. And
they're cashing out early. They're cashing out early not because they don't like what they're invested in, but because currently those who are going to retirement in a DC scheme have pretty small pot sizes. That's right?
Exactly, yeah. So it is part of the evolution, the shift from DB to DC. The current members might have a very small pot. They might have a DB pension alongside it.
Right.
Whatever the reason is, I think we're seeing a lot of members doing this and trying to take some liquidity. And what that actually then means is we need to offer them that liquidity, and we need to really focus on assets and an investment strategy that works for the current cohort. So some kind of intelligence needs to be baked in to say, what do we need now, but also what do we need later. So what we need now is we need a degree of short-term capital preservation. Clearly, if we can get some inflation linkage into a portfolio, that is great. But we want them to be able to see their pot and be able to draw it down over a shorter time period. That is a different set of private market assets than what we use early on during the growth phase, clearly. I think that means it is assets that really support the kind of their needs. I don't think we talk about it nearly enough. The private market assets that we do have in retirement,
Right.
they are supporting all of
We
this.
already
So
have
what do
some
we,
in the-
What do we do? Yeah. So we have a clear focus on short-term private market credit, so less duration, therefore that kind of nominal stability. And what we put next to these kind of short-term private market instruments is a range of, let's call it semi-liquid alternative credit strategies, some insurance-linked securities, some asset-backed securities, and then on the property side, maybe some long lease properties. So that again gives a lot of stability and some inflation-linked kind of income as well. Now, what we expect clearly is that this pattern at retirement, that changes over time. So cohorts, members that never had a DB pension, or where at least the DC is a much bigger part of their portfolio, they will start to become the ones that are in retirement. So what we are doing is we are monitoring really closely how that transition takes place.
Yeah.
We monitor the member behavior as well, so we are aware of what they need.
Yeah.
And so the idea is clearly that the type of private market assets therefore change. So what do we think is the kind of the future for private market assets in retirement? You mentioned that already. There are some private market assets that seem quite well suited for that future world. Property and infrastructure, other more real assets, they tend to give us some of that inflation-linked income stream, the stability of the income that kind of Robert also talked about. They are clearly part of the toolkit that we will want to use in the future. I think it is very much about thinking about this as a toolkit. There's lots of different elements, clearly, of the retirement solution. These are still risky investments. They're not going to replace the annuity in that sense. And so there's lots of thinking needing to go into how these different building blocks can really be combined in the best possible way to work for the DC members going forward.
Great. That's really great to hear, and looking forward to all of the evolution that's going to come as those members start to have larger pot sizes. Robert, can I just take you back to something we were talking about earlier on? You talked about how the trustees had got comfortable with private assets. But what we see when we talk to employers is we're seeing many employers actually selecting the default that's got a higher allocation to private assets. When you're talking to other companies or when you're talking to people in DC, are you finding that people are getting more comfortable with private assets in DC just because of the passage of time, or is it something else?
So I think the passage of time helps, but I don't think it's the driving factor. So I think there's a change in the DC market from, we've had really, if you think where fees were when I started my career for managing money, they're probably up at 2% and they've done nothing but come down and down and down.
That's good for the member.
Very good for the member. So, members in Master Trust get a remarkably good value for money. In all the major Master Trusts are so much more competitive than anything you can buy as an individual and anything you could have bought historically. And I think as we've got to that point where fees are much lower, people are now thinking more about, well, what am I getting for my fee and what's the value for money? And that's where the trustees obviously do a lot of work. And so a lot of the employers are actually saying, well, no, we're happy to pay more to get more.
Right.
And, I liken it to a flight. You can sit in premium economy, you can sit in business class. Both will take you from where you start to the same end place, but you'll get a slightly different experience. And I think in a sense, this is the same. People went for, I need to get low cost and get there, but actually maybe there's other ways of getting there that might be better, including private markets. And private markets clearly cost more to manage and therefore cost a bit more. And so I think employers have come that way in some cases. And as you say, a number of employers have chosen a more expensive but as good value for money product by going into private markets. And I think part of that is they've got reassurance from more education, more information, the government stance on these things, and talking to their employees and seeing actually what their employees want.
Yeah, interesting.
So actually getting comfortable that this is something their employees want to invest in, want to be part of. So there's a big step change in transparency in education. It makes it much easier for decision makers to get there. And the other point maybe people have got a little bit too comfortable with private markets as well, because there's so much chat about it. Everyone assumes, they're risk-free. From a trustee perspective, as I said earlier, we have a lot of lessons of history that tell us to be careful in illiquids. And it's not that they haven't given returns in line with quoted markets. It's just that if you get the wrong liquidity or you get a mismatch of your assets and your liabilities and your cash flows at a moment in time, you can get yourself in a mess. And we see this regularly throughout history. And therefore, it's really important for the trustees to remain focused on managing that downside risk first and foremost.
Oh, that's some really great points. Thanks very much, Robert. I want to try and build on some of those points in a bit more detail. The UK landscape is changing really fast in relation to private assets and DC schemes, with a number of different master trusts launching, different number of defaults with different amounts in private assets in it. And then we've got this value for money coming along. What's your view about how much or whether private assets will still be or will be a big feature in DC in the coming years?
Obviously, the biggest thing we've got in DC in some sense is the consolidation. So we're going to end up with a smaller number of much bigger funds. That's a far more suitable way to invest in private markets. You really can't do private markets unless you're north of 10 billion. It just doesn't really make sense. So we have seen this shift towards multiple default options with different characteristics, different levels of exposure to private markets, and it reflects the maturity of the market. And one size doesn't fit all, and that's appropriate. The value for money framework is going to really focus this debate, because actually most people are fairly close to the index in quoted markets. So actually to make money in quoted markets is going to be down to geographical distribution rather than stock picking. And therefore private markets could end up being the differentiating factor on value for money for a number of funds as we move into the value for money framework. So I think what you're going to see is the people who manage this well are going to deliver really good value for money.
Right.
But as all asset classes, the people who do it badly will deliver quite poor value for money. And actually within private markets, the dispersion of returns between the best and the worst is greater than it's going to be in quoted markets.
Right.
So this is going to be a key area where you need to make sure you've got the right people running your money.
Yeah, that's a really good point, Robert. And it's true that not just a higher allocation doesn't necessarily result in a better outcome or better governance. We need to make sure we've got the right structures, the right people managing those assets for DC members.
Absolutely, and just putting more money into it doesn't, if you do it badly and you put more money in, you're just going to end up with a worse outcome.
Great point. Really great point.
Because there's no guarantee that these private markets will outperform quoted markets.
Yeah. And it depends what time horizon you're looking at.
Absolutely. And it depends which private markets you invest in. If you're investing in private market credit, you don't actually necessarily expect it to outperform quoted market equities.
Yeah.
But if you're invested in private equity, you would hope it would outperform quoted equity because you've got a lot more leverage, but you've also got a lot more fees. So for it to do it, you actually need to do it in the right way. So if you're not big enough to do co-invest, then private equity may not deliver those excess returns.
Yeah, really great points. Thank you. Do you think that investment in UK private markets is going to improve growth in the UK economy?
Yeah, well, this is a absolute key question for the government. And the trouble is, sort of the assumption, well, we're going to put in private markets that was going to deliver growth, sort of misses a cause and effect in the middle there somewhere. So it depends what you invest in private markets. If I go out tomorrow and I buy a building, buy the L&G building we're talking about today, it will make no difference. I may hit my Mansion House 5% target. It will make no difference to UK growth. If I buy secondary assets off people, it will make virtually no difference to UK growth. So if this is a movement by either the government through mandation or trustees through a desire to create more growth because that's in their members' interests, then the only really ways you can do that are provide more credit to people, particularly smaller companies, investment in venture capital or growth equity, and returns on venture capital in the UK have not been particularly successful over the last 4 decades.
Right.
Growth capital more so, or build things.
Yeah.
And that's the thing that no one's yet doing. L&G have a history of doing this on their own balance sheet. If you actually develop cities, do what L&G did in Salford, what they're doing in Cardiff, what they're doing in Sheffield, then yes, that can help growth. But if you just go and have an allocation to private markets, it may do nothing whatsoever.
No, not going to make any difference. Great. That's a really great answer. Thank you, Robert. There's so much more we could say on this topic, but we're running out of time. So I want to close in our normal way, Martin, if we can, and turn the lens on ourselves. So our own private market strategies at scale since launching in July 2024, and we're reinvesting over 70% of our assets back into society. That is huge and something I think we should all be really proud of. What are you most proud of over the last few years, and what's coming next?
Yeah, thanks, Lesley-Ann. I think if I look back over the last couple of years, there's not a specific point that I think we or I am most proud of. It is the fact that really, number one, we've created a private market vehicle that works for DC members, that we've been able to scale up, that is now 3 billion in size, and we have reinvested 70% of that into really interesting private market assets, housing, infrastructure, renewables, and so on. These long-term projects that the members like and that they kind of recognize. That is a really important part. And the second part is how we've managed to integrate private markets then into a default strategy, a target date kind of range that is actually at scale now, that is already hitting all of the government minimum requirements for 2030 at this point in time.
Amazing.
That is, I think, a great thing to see. What's really important now is clearly what do we do with this? How do we develop this forward? So we have a huge opportunity now, given the scale, which is important on the private market side, to develop this forward in a kind of a thoughtful and a responsible way. We want to continue to add value. The focus remains very much and is very much on the members to give them really good kind of returns, good outcomes, to deliver the diversification versus the liquid market component of this kind of strategy, and to really just make it in a fair and DC appropriate way.
Thanks both. That's been a really helpful look at private assets, both from the fund manager perspective and from the trustee angle. So thanks. And thanks all of you for joining us on DC Close-Up. If you'd like to explore more, you can find further insights on our DC Private Markets webpage. See you soon.